Welcome back to Primary Source China Investment. Today, Peng Guo and I have two topics for show H3. So let's get right into it. The first is that Beijing unlocked, just Friday, Beijing unlocked the final piece of the fixed income market to foreigners. The announcement on Friday allows foreigners to access the exchange-traded bonds in Shenzhen and in Shanghai. For a bit of context, the exchange-traded market only represents about 10% of the total bond market. The other 90% has already been open to more than 1,000 foreign institutional investors. And of course, the interbank, the Hong Kong Bond Connect, right? That's already been open to the foreigners. So this is really the last piece of the market that's now being opened up. So China's onshore bond market is already the second largest bond market in the world with a market cap of about 20 trillion US dollar. Offshore investors, which the PBOC says represent about 3.9 trillion renminbi, $600 billion. That's the foreign investment. So it's probably 5% of the market. And that includes the big sell-off that's been happening since the beginning of the year, where about 225 billion renminbi and 5% depreciation in the currency. So there's a lot of moving parts here, but remember, the takeaway is the fixed income market onshore in renminbi is now completely open to institutional foreign investors. Peng Guo, what's your thoughts here?
I think that's really like the big news. So even they get a small percentage, but that's probably most important percentage, because this 10% they give the liquidity, so that you can trade it at any time, and it's more quickly reflect and the price in market conditions. I know like the interbank bond market, that is big, but most of the time the lack of the liquidity is harder to sell it, or you get the appropriate the pricing into the bond. So China know the bond market is a weak part of the entire capital market. They try to get improve it, but I haven't seen too much progress in the recent years. I think this time, if open to the international investors, it will be get the more formal and more fundamental based investors coming into this market, which is I think pretty good to improve the market efficiency. And also I see China get a lot of the convertible bond, which combine some kind of the equity and bond features together. Those areas also pretty complicated and different animal in the market. So I think and finally, probably I hope this market and be more efficient and more easy, provide a higher liquidity. I personally always like the liquidity. If no liquidity, nobody knows what's going on.
What's the value?
Why you sell it, or unless you hold it to mature.
Yeah, it looks like this is going to benefit the existing market participants. You know, I know a lot of the foreign fund managers who do manage China fixed income. They've been calling for this for a while because, you know, that last 10% is an important piece of the 10%. And, you know, now the proverbial playing field is level. So all market participants can access all aspects of the market. So I think that's a good thing for liquidity, for transparency. You know, it used to be the interbank bond market was basically traded on like a WeChat platform, which was totally ridiculous. So that's now, right. You know, the market becomes more and more mature, which is obviously a good thing.
And also it's pretty good to the future market, because you can hedge your risk through the 5 years and 10 years bond futures.
Yeah, so the yield curve shouldn't, the transparency, liquidity, and you know, the underlying trust in the yield curve should improve over this.
Mm-hmm. Yeah, definitely. Yeah.
So my only worry here is, you know, everybody who's listened to me for more than a decade knows I love the onshore fixed income market. I've been, you know, managing those kind of assets for more than a decade now, and everybody knows how much I like that. But, you know, U.S. investors are still not impressed, right? The largest ETF, the one we talk about a lot, CBON, that has $120 million under management. That's absolutely nothing. Compare that to, there's a UCITS product in in Ireland, right? So it's UCITS compliant, and not to get detailed, but there's a European product by iShares, and that fund family has 7 billion focused on the onshore market. So I'm just trying to figure out why this asset class hasn't taken off for US investors.
I think a couple of reasons. I think firstly, based on the U.S. Institutional investor, they have the traditional asset class. China bond is definitely not a big kind of the independent asset class into their target. So it's not on their radar at all. That's probably the major reasons. And secondly, I think most of the time they do the performance evaluations or whatever, they probably have the threshold. Maybe 100 million is too small to reach the threshold to enter into the radar to doing like that. I think probably ways is they can improve the advertisement and try to brand this ETF as the independent asset class, which is offer the from the professional performance evaluation perspective to doing like that.
I agree with a lot of that. There is really a very low level of understanding and education about this asset class. I would also say, if you're a pension fund, if you're an endowment, and you don't have your own allocation, you don't have a QFII quota, there's not a lot of things you can buy. So it's actually not an easy execution. Also, those large institutional investors are precluded from investing in a fund like C-bond because they can't own, more than 5% of any one name. They can't own more than 5% of any one fund. So even if they wanted to allocate, well, I can allocate maybe 7 million. Well, that's not enough, right? So then I don't allocate. So there's a lot of issues with the asset class. But I
think probably for them, this is they don't know a quick shortcut how to boom the fund size. Because there's a really China-related fund, they just they should more develop the product from strategic perspective rather than tactic view. So they should boom this product in the China market. So as long as because it's also home country bias. So a lot of the China investors they go to the overseas. They still buy China stocks, China bond. So if they can target those market and boom it, and they definitely can increase the size. And as you know, as soon as the size get increased, a lot of the institutional investors get attracted to this area. So it depends. You get a positive circle or negative circle.
That's an interesting strategy. Maybe we have to pitch them. So
they should have pay us to get this strategy.
That actually is a pretty good strategy. There's actually a lot of money, in the U.S. already that is, tangentially tied or China adjacent money. So the second topic I want to get to pretty quickly today is the news cycle. We keep seeing the bad news out of China continues. So it's something that we've covered for a while, but it's beginning to feel like a lagging indicator. I mean, Li Keqiang is pounding the table. Government is stepping into all sorts of areas: tax breaks, employee benefit subsidies, loan growth by banks, and all sorts of things. Even local governments are stepping up. I mean, I was reading the other day, Shenzhen is doing government subsidies for purchase of electronic vehicles and computers and smartphones and all sorts of things. So, there's a lot of stimulus in the pipeline, although, it does take time to get through. But I'm looking at what's happening in the market and then what's happening in the news cycle, because there's been a lot of bad news, and, we've covered it a lot. And the GDP numbers, the banks have all taken them down. The foreign banks have all taken them down. Now, the consensus is a 4.2%. So, the retail sales numbers were bad, real estate numbers were bad, unemployment rates are at multi-year high. But when Premier Li was touting all of this stimulus, the stock market was down. By the end of his speech, the stock market was up. And the CSI has been down, 20% year to date, 31% from a multi-year high. But in the last month, it's up more than 6%. And we've talked about this in the past. The PE ratio for the CSI major market index is about 12.3. There are a lot of indicators, and there's a lot of yield-centric big names. Look at Peng An, ICBC, or China Merchants. They have yields of 5.28, 4.12, and 3.26 respectively. So I'm feeling that the bad news is now the lagging indicator for the investor sentiment on the ground. What's your thoughts, Peng Guo?
I think because China has already got a lot of the research about such kind of things. That's called the policy bottom. They have the technical bottom. This is from the market, the technical analysis. This is called policy bottom. So at the bottom area, it seems like that. The government get a lot of the policies, stimulus package for the economy. So what you can say that the entire China government system, they have to work to save the economy. So it's really in very bad situations right now. So people understand that. I think this right now is really just a guess. Is this the bottom or not?
Yeah, it's speculation, of course.
Yeah, that's people just think it kind of could be worse or not. Looks like today is like Beijing and Shanghai. They pretty much have no new COVID cases, so they probably get released lockdown into the two big cities. And other area looks like getting better. This the COVID get a big impact for the entire China's economy. So that's totally screw up everything. Hopefully, they can get the better strategies to manage the ongoing COVID cases. I think most likely that could be kind of the policy bottom, and if this area they can get a stable and get some kind of the recover, that would be very positive.
Yeah, when I look at that kind of recovery, the shutdown is going to affect exports more than it's going to affect the movement of goods domestically. So we've all seen those pictures of all the shipping boats in the harbor, and there's nowhere for them to go. And eventually, when they offload and then reload and then export, all that's going to take time to work through. But made in China for China, I think that's going to move with a lot more turnover and velocity, because you only have to ship internally. You don't have to ship externally, and you don't have the logistics issues that you have exporting.
That's true. Definitely the international transportation get affected a lot. I see the picture, a lot of the boat stay on the sea to waiting for get into the port. That's very, I think that's pretty new for the China government, especially like after 2 years, some of the city get experience, but I think many areas have no any experience or no good experience to handle such a mess.
Right, I do see a lot. Again, this is more about that bad news, and I'm trying to forecast what comes out of that bad news, and for my money, it does look like those big domestic names, those big brands, those large cap entities are the ones that are going to emerge the earliest, the fastest, and then get re-entrenched in their position. So those big state-run, or whatever you want to call them, those big entities are the ones that are going to benefit the most coming out of that. And it looks like those entities are going to be the ones that get the stimulus. Those are going to be the ones that are beneficiaries of all of that government policy that goes into effect as well.
Yeah, at the same time, we should distinguish short-term impact with long-term impact. So we cannot take too much actions for the short-term impact to that, because after COVID, the demand could bounce back. Nobody knows how quick it could be.
Yeah, because savings also spiked on the mainland as well during this period. So a lot of things to watch. We're going to leave it there.
Same thing in the United States.
Absolutely, but now it's changing. It's like a weird thing. It's like they're data lagging also. So we're seeing a lot of weird stuff coming out of the data. But we'll cover that in the future. Thanks for tuning into H3, and we'll see you next week.
Thank you.